Are you ready to make some money? I'm going to give you the top stocks to watch in August of 2026. Let's get into it. All right, I'm not going to waste any of your time, so let's just get into the top stocks to watch August 2026. Please give me a like and subscribe. I really appreciate it. So I got HIMS, Celsius, Salesforce, ServiceNow, and Netflix, and I'm going to break down exactly why I think these are stocks you should be watching. HIMS and hers, the last month has gone down pretty significantly. In the last 12 months, it's gone down. As you can see, all of these stocks I have to watch are all pretty negative in the last year. And the reason why is because I'd rather buy a stock that's on a discount rather than it being up 100, 200%, right? So these stocks I really do think you should be watching because they are clearly, the momentum is going downwards, but I believe all of these companies are going to be growing, and so will the stock. Excuse me, I'm feeling a little itchy in my throat for some reason. So without further ado, let's go to HIMS and hers. So you could have bought the stock at this price basically of November of 2024, almost 2 years ago. It's also down 57% since October of 2025. So HIMS has not been performing well at all. And if you know anything, well, the FTC just sued HIMS for unlawful privacy practice, deceptive and unlawful privacy practices, as well as saying that consumers are getting charged before they even talk to a doctor, and then it's hard to cancel their subscription. Now, I am a subscriber myself and a HIMS shareholder. I understand how they do charge really quickly, but I was able to talk to someone and get something done. It was a blood test. I didn't actually receive any medication. You know, I didn't get charged before I even got approved and all that stuff. So you know, my personal experience has not, they have not done any of these things, but right now the FTC is getting sued, and it said it's been a 3-year investigation. So it's been a while where HIMS and hers has known this, and they've probably fixed the problems by now, right? So will they win the lawsuit? So this is how it works. You can either win the lawsuit or you can get a settlement, right? Settlement, you're saying you're not admitting to any fault, but you're paying a big fine and you just kind of get out of the court. Or if you really think you haven't done a thing wrong and you got the money to do it, you defend yourself and you show the courts, hey, we didn't do anything, right? So if they do a settlement, they agree to a fine and strict data monitoring without admitting fault, just to end the litigation quickly, right? Now, they will be paying money and they will have to have 20 years of federal audits. Now, if HIMS actually goes through with it and says, no, we didn't do any of this ever, then they're going to prove that their code never shared data, right? Because that's also what it's about, the sharing consumers' sensitive health data, and that their billing was perfectly transparent, causing the judge to throw out the case. Now, that may be good legally, but financially, they're going to be paying a lot of fees and just the defensive legal costs, right? So the most likely outcome is a negotiated corporate settlement, historically resulting in a multi-million-dollar fine, a court-enforced ban on sharing tracking data, and 20 years of mandatory independent privacy audits. Now, the overwhelming historical data shows that over 90% of federal regulatory corporate lawsuits end in settlements rather than a full trial. So I'm putting my money, it's a settlement. But what's that settlement going to look like? Well, financial penalties, they're expected to land between 15 and 30 million, right? Permanent behavioral bans where they can't be using third party like Meta and Snap to be tracking user activity to specific medical conditions. And then they're also going to have to, you know, mandatory business restructuring with the auto renewal and all this and that. I mean, you want to have your medication on auto renewal. I mean, that I think should be fine, but I guess apparently it was hard to cancel. I can cancel within 3 clicks. So that doesn't apply anymore. And then they'll also have to do 20 years of auditing. Good news, right? Peptides. Now, they just had the Pharmacy Compounding Advisory Committee, right? They voted 8-6 that the peptides will be reclassified, most of them, right? Now, most specifically BPC 157 and KPV were voted 8-6, and those are really big for HIMS. Now, if they actually approve it, now this was just a panel saying they recommend it, if the FDA actually approves it, the financial impact on HIMS and hers would be transformative. While HIMS, you know, they've recently gone, to the branded, toward branded weight loss offerings, right, with like Wegovy. hurts their margins, right? They have to pay Novo for Wegovy and then sell the Wegovy to patients. Whereas if they were able to just make it themselves, like what they can do with peptides, they control the price, their margins go way up, and they don't have, the cost is way down, right? So then they're making more money. So that, it will really help accelerate their path toward the 6.5 billion revenue that they have in their goals, and they've been doing it every earnings. I actually went to the doctor recently and they had the sign up. Now it's a really like little science. Obviously they're not like advertising peptides really crazy yet, right? But it's already showing up in doctors' offices, and I do believe that this will be the future of medication, in terms of this will be an alternative way to get some medicine and treatment. So that's that, right? Hims and Hers is also actively hiring peptide, positions, right? Peptide API, operation managers, facility maintenance, and then the peptide API operations, and then site leader for peptide. So they're clearly hiring and getting ready to start, making some peptides. And their next earnings is going to be August 10th. So it's going to be big. Their latest earnings was a disaster because of Wegovy and the lawsuit. So even though there is a lawsuit now, again, I don't think it's going to be nearly as an impact because they now have been selling Wegovy. I think everything is going to look better. Now their margins are still going to be compressed because of Wegovy, but I think they'll have a lot of good things to say about peptides, how they're going to start getting things in motion. I am afraid that they are going to say peptides are going to take a while, because peptides could take between 12 to 18 months for it to actually be approved by the FDA. So we will see exactly what happens, but August 10th is a huge day for Hims, so it will move really big. Celsius, that's my number 2 stock to watch. Now it's down 69% since May 2024, and you could have bought this stock at the same price essentially August 2021, almost basically 5 years ago. Celsius has changed a lot in the last 5 years, right? But just as of recently, their recent earnings report, which they're going to be releasing their earnings soon as well, but their most recent ones, right, they're around 21% of energy drink market share. About out of every 5 energy drinks being consumed, one of them is being Celsius. Now they have a 99.5 weighted retail distribution, which is essentially for every 100 cans of Celsius, Alani Nu, whatever it is, 99.5 of them are actually exiting through a consumer's hand. So that's also good as well. And they are the number 3 energy portfolio in the US, right? Now they have a top dog partner in Pepsi. And one thing that happened is this distributor termination fees, right? So they've had, with Alani Nu and Pepsi, they've had a lot of distribution, changes. And so they had to get all their stuff into the Pepsi system from Alani Nu when they bought it, so they had a lot of distribution termination fees. That is now going to be gone. As you can see how much it changed, from before. They were spending 87 cents in the whole year of their EPS just towards distributor termination fees. That is going to change. It is going to change. It was 21 cents just in Q4. In the latest quarter, it was only 1 cent. So their earnings this year is going to be way better. One problem with their earnings that they will be reporting is that it's going to be compared to a big jump, right? They bought Alani Nu, and so the revenue went through the roof. Now you would assume that when you're growing your revenue 83, 170%, 100, 150, 40, whatever it is, right? You're growing your revenue by a lot every year. And hey, why isn't the stock going up for the year? Well, the main reason is because they essentially bought the revenue with Alani Nu, right? So even though, yes, the revenue went up, it wasn't like Celsius grew. It was they bought Alani, and Alani is now integrated into their financials. The hard thing is now they have to, they're going to have to record, you want to record over 780 million, right? But you have to record a decent amount of 740 because this is what you're going to be compared to. So their next number is not going to be nearly as high as all of these. It's going to be like 10%, right? If they reach 800 million, that would be about a 10% revenue year over year increase, which you would look at them and be like, that's not that much, right? So it will be interesting to see how the market reacts, because the revenue was going up clearly when they bought Alani Nu, and the market didn't really like it. So now that it's going to be compared from a year ago with a lower growth rate, is the market going to like it? Because I mean, look at those numbers; they're great, right? But we'll see what the market does. Now they have some big insiders buying their own shares, right? So now we have John Feely, the CEO. He bought a bunch of shares, and also the chief operating officer. He bought a lot of shares. Usually, when these guys are buying shares, that's because they believe something, that they believe in the stock. They believe that it's going to go up, right? So that was my phone. So they don't buy shares when they think things are going to go down. They will sell shares, I guess, when they think things are going to go down. But even at that, they're not selling at all. They're buying shares. Now again, their earnings is on August 6th. So that is coming up even sooner than HIMSS. So be ready for some big moves here. It is July 30th as of today. So August 6th, be ready for it. My number 3 stock to watch is Salesforce. So down 50% since December 2024. So you could have got this stock, back in January of 2020 for the same price. So this stock, again, one that's just not doing well. And these are the stocks that I like to buy because eventually they'll go up, and when they make the moves up, they will be significant. So one thing I love about Salesforce is that trying to transition out of Salesforce for any company is actually it's highly complex and very difficult, right? The platform's deep integration into a business's process, custom coding, and vast data volume create significant sticky barriers to exit. So it's really hard for a company to leave. It's also costs a lot of money and takes a lot of time. 150 to half a million, 150,000 to half a million plus 6 to 12 months just to get out. Plus a bunch of them are on contracts, right? So Salesforce, you're pretty locked in. They got their customers, they just have to grow. Now their expenses have gone up a little bit because of the AI and all that, but everything else has gone pretty well. Now, this was in May 2026 right after they released their earnings. So this is basically the same. And when you look at the stock price, right, it's a lot less. The market cap is less, right? All this. But then when you look at the revenue, they are making so much more in revenue. Their net income is so much more. Their EPS is so much more. Now, obviously, the PE ratio used to be a little bit high, and now it's come down to, kind of normal area. So as you can see, they've grown a lot, but the stock price hasn't. So hopefully the stock price eventually gets there. Now they have a fiscal year of 2030, the revenue of $63 billion, and then 11% compounded annual growth rate from 2026 to 30 of the revenue. 11% isn't seen as a whole lot, but they have great profits and they're very sticky. And right now they have expenses because of AI, but AI is really going to be a big driver for these the software companies, right? The SaaS companies, because it should be able to make things cheaper for them eventually and a lot easier and quicker and more efficient. They also announced a huge stock buyback, right? They've just recently bought 114 million shares purchased, but then they also have another, it says representing half of the 50 billion, and I believe they upped it to, again, another full 50 or 60 billion. Now their next earnings is coming out August 26th, so be ready for that. They will not be moving as much as HIMSS and Celsius, but again, just be ready for a big move. ServiceNow, my number 4 stock. Down 52% since January 2025, right? And it's gone nowhere since December of 2020, right? So almost 6 years and this thing has gone nowhere. That's pretty crazy. Now, they have about 630 customers spending more than $5 million. That's pretty crazy, right? From financial services, technology, retail, healthcare, manufacturing, government, they are everywhere. Now they, as well as Salesforce, a very sticky product. They're considered one of the stickiest products in enterprise software. Best in class retention, they consistently maintain 97 to 98% renewal rate, so their customers are constantly coming back. And it doesn't just sit along tools, it acts as like a control layer that coordinates work through the IT, HR, all of that, so it's very hard to just get out. And then also their net dollar retention, it's about 125. So when the customers come back the next year or their next contract, they're spending more. They're not just spending the same amount, they are going to be spending more. Their recent earnings that came out, because they actually did have their earnings come out recently, I graded it a C. The subscriptions went up 23%, total revenues went up 23%, but again, the cost of revenues, right? Their expenses went up significantly, which I did not like, and it really hurt their net income and their EPS. But one thing that was noticeable is that when they announced it, the stock actually has gone up since then. So even though they reported a negative, net income and negative EPS growth, the stock went up. And that's showing that there's belief in this company and belief that what they are doing is going to really produce better revenues, and that AI will lower their cost of revenue eventually, right? It's weird to see that you have a negative 9% and yet the stock went up. But that's just what happens. And you have these other companies that are spending so much and their stock went down, like a Meta and Microsoft, right? Or Microsoft went up, but a Meta, right? They went down and they've been spending a lot of money. Apple's gone down, and that's because they have their services is going down. So when you have ServiceNow and you see their cost of revenues going up, but the stock goes up like it did, even with the net income down, that means Wall Street is having confidence that this could be the bottom. This could be the bottom, and now we're going to start going up from here. Netflix is my last stock to watch. After this, I'm going to show you the results of all of the stocks that I said last year. So we're almost at the $70 range, right? It's at 73. If it hits $70, that's November of 2021. But so far, it hasn't gone anywhere since October of 2024. And it's down 45% since July of 2025. So it hasn't moved anywhere, hasn't gone anywhere, right? I give them a B grade on their latest earnings. The revenues went up 15%. The cost of revenue went up 13%, so that was less. Now, sales and marketing, other stuff went up higher, but at the end of the day, their net income and their EPS grew 44 and 46%. So they were growing their bottom line significantly, and I really like to see that. Now, the thing about Netflix is that they are one of the top dogs in terms of entertainment, streaming, right? You have Netflix, Spotify, Amazon Prime, and they can not charge whatever, but they have gotten more, not complex, but when you look at what they used to charge just 10 years ago, and now look at what they're charging, it's over double, right? And they have different tiers, so they're able to really reach different demographics, different financial statuses, and and they're really sticky. People think, you want to go to a movie, go see a movie in a theater, it's going to cost a whole month of Netflix, right? So I think Netflix, when people have money, they want to have it. It's a nice luxury to have, and when you don't have money, it's one of the necessary entertainment streaming platforms to have. I also look at their stock price, and as you saw, the revenue went up 15%, the net income went up 44%. So let's say the revenue goes up only 10% and the net income goes up only 20%. The stock price should be between 150 and 225 by 2030, and that gives you a 20 to 32% compounded annual growth rate. But if you know anything about compounded annual growth rate, you want a good, if you can even get 15 to 20, that's great. The market is usually giving you between 8 to 11%, somewhere around there, on average. So if you can get 15 to 20% on a compounded annual growth rate, that's amazing. This thing is offering 19 to 46 up to 2028, 20 to 37, and then 20 to 32 by 2030. So to me, Netflix is a buy. It's one of the top dogs, again, in the streaming and entertainment. So I'm going to start building a position on Netflix for the next, I don't know, 6 months maybe. Now, my top stocks to watch, this is a year later. This is what I said to watch in August of 2025. Now, I'm going to be wrong sometimes, right? So, I had Apple, Amazon, Celsius, Fubo, Hims, and Hers. Now, Fubo is my big mistake. Celsius and Hims, even though they are negative after a full year, I still believe that these companies will be better. I also did, these are stocks to watch, not necessarily stocks to buy. Fubo, I was saying it's a stock to buy, and it's gone down significantly since then. I have sold it a while ago, but I did say it was a stock to buy a year ago, and so I have to put it on here. So yeah, I didn't do very well in August 2025 and what I was saying. Celsius and Hims, those are the ones that really burned me. I mean, Fubo, yes, Fubo's a burn, but I didn't continue to buy into it. I let go of that a while ago. And, but yeah, this is, I have to show my results. I have to show what I said, what I did. I put my money in all these. I didn't put my money into Apple. I don't know if it had to do with earnings or something that came out, but I just believed in Apple at the time. I didn't buy any Apple, but I do have Amazon, Celsius. I did have Fubo and Hims, so I put my money where my mouth is. So I did. My portfolio saw some of these results. I mean, right now my 100K challenge, it's at 9,300 or something. I have a lot of Celsius and Hims, and it's not doing well, right? So thank you for watching. I really appreciate it. Again, these are just the stocks to be watching, not necessarily to be buying. There's all kinds of stocks you should be watching, from SpaceX and all that stuff, Microsoft, Meta. Meta went down so much, right? You got AMD, Micron. There's so many. You got Cheesecake. There's so many stocks you could be watching. It doesn't necessarily mean to be buying them, but you want to look for opportunities. Now, something like a Cheesecake that's gone up so significantly, I would not recommend buying it at this level. I think it now has more chances of going down than it does of up from where it currently is. That being said, it's always good to be watching stocks that you like, that you enjoy, that you know, because when they tank, then you can actually buy a piece of it. Like Nike's been down for a while, right? If you like Nike, maybe it's time to open a position. You could have bought that stock in 2014, I think, 2015 for the same price. So anyway, that's my list right there. And let me know what you're buying, what you're watching, and yeah, never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.